Hello, and welcome to Kyriba's Treasury Best Practices webinar. Today, in conjunction with Actualize Consulting, we're excited to bring you a new topic, simplifying regulatory compliance for your FX hedging program. Before we begin today's webinar, let's go through some of our housekeeping elements. Next slide, please. Today, the webinar for all participants will be placed in listen-only mode. If you do have questions at any time during the webinar, please enter them via the gray GoToWebinar box. Given that today is only a 30-minute webinar session, we may not be able to attend all those questions, but we will respond to you offline if necessary. If you experience any technical issue through the GoToWebinar experience, please contact the support team at 1-888-259-8414. Today's webinar does offer CTP accreditation, and you'll receive those approval letters over the next several business days. We'll also be providing today's webinar in a recorded format link, as well as the slides used, and that link will be included on the email that is sent to all registered attendees. Next slide, please. Today's presenters are Jonathan Zeman from Actualize Consulting and Thomas Gavigan from Kyriba. Each presenter will introduce themselves as they go through their specific section of the webinar. So let's take a look at today's agenda. Today we're going to cover FX program management and look at some of the procedural elements to manage your FX program. We'll look at valuations, which are the foundational building blocks to proper accounting treatment. We're also going to discuss derivative accounting compliance and automated accounting. With that, let's get into today's webinar. Thomas, I turn it over to you.
Great. Thanks so much, Tracy, and welcome everybody. As a brief introduction, as Tracy had mentioned, my name is Tom Gavigan, and I am responsible for managing the North American pre-sales team here at Kyriba. In my role, what we do is we work very closely with our account management team and new sales team here and help provide the system demonstrations, help companies evaluate the solution as a part of their overall kind of treasury needs. So we focus on their cash management, payment management, risk management needs. Prior to coming into Kyriba a couple years ago, I worked with another vendor in this space and held different roles in product management, managing implementations, and also within pre-sales there, and had a specialized background in FX in relation to trading systems and risk management technology for banks and brokerages mainly across the globe. What we're going to do in this section is really kind of cover those two first bullet points of the agenda in terms of managing the overall FX kind of and currency risk management programs that a company will follow, and also kind of dive a little bit deeper into some of the valuations and why that's so important as a critical element to the overall accounting treatment that is to be followed, which Jonathan will be focusing on in the session. As a foundation, in terms of managing the currency risk management program of a company, really falls into four main categories of an overall kind of workflow that a company would follow. We'll walk through each of these, or I'll walk through each of these different components and explain the main kind of functions that are to be followed within each. And starting at the top, we're going to, and working our way down, we have our exposure management, which is a focus on basically collecting, identifying our exposures in the company. Then we go down into the front office, middle office, and back office functions. And these work in succession of one another. Now, a key thing and something, as we probably all know, is that these functions are most likely not covered by different groups or offices, as the name might imply, within the organization. They're just the key functions that are required kind of in that whole end-to-end process of an FX program to kind of add that auditability of the whole process, that segregation of duties, which is ultimately very important in terms of who is responsible for performing kind of each of these different functions of that process. So as I said, what we'll do is we'll start up top and kind of discussing the exposure management. This is the first part of your overall kind of FX program, regardless of the size of the company, regardless of the complexity of that organization. The collection, identification, aggregating exposures to be hedged by that organization is going to be that kind of starting point. Exposures are going to reside and become a part of the balance sheet hedging program and or your cash flow hedging program that you're to follow, and that's put in place. Deciding between balance sheet hedging and cash flow hedging programs is not an either-or decision. It's not one or the other. It really just depends upon the scope of the various exposures and currencies that you're exposed to, and also really upon the ease of collecting and identifying those exposures. The foreign currency exposures in recognized assets, liabilities that require translation and remeasurements that could adversely impact your earnings, P&L, and are therefore going to be controlled as a part of that balance sheet hedging program. Items that you haven't recognized on the financials will be a part of your cash flow hedging program. It's critical for both programs to centralize these exposures, categorize them accordingly. The origination of the exposures can come from a number of different sources. So it could be your ERP systems, it could be your forecasting and budgeting tools that you're using, and other applications that are specialized in kind of calculating and bringing out those various exposures from your financials. As a part of this kind of step or process, it's important to really invest the time into it and identify those natural hedges, those internal hedges that might be in place, and to have the tools, to have the technology in place that can easily give you the ability to integrate that data in to those other applications, bring the exposures together and consolidate them together to then be a part of that next part of this process, or the next step in the process that's going to be followed, that happens and occurs within your front office. So moving into your front office, the activities followed here really set kind of the foundation of your overall hedging program. It's within this, this function where a company would put in place basically the policies that are going to be followed and the guidance that is in place for the overall program. For audit purposes, internal audit, external audit, it's the standards that must be followed. In the prior step, we collected our exposures. We identified where those exposures are. However, it's here in this step within the front office that we decide, well, how are we going to hedge against these exposures on an ongoing basis? You know, as we know, corporations, companies, they don't speculatively trade currency, right? They're trading for a given purpose and really have to establish the rules that are going to be followed as a part of that overall program. Policy setting is going to involve basically the identification of the overall objective of the hedging program itself, and also basically the strategies that you must follow. The questions that you'll ask here, what type of instruments are going to be included in our program? Is it going to be, as we more commonly see, you know, the use of simple kind of forwards, swaps in the market, or are we going to extend that? Are we going to leverage option strategies as a part of that overall, as a part of the hedging program that we're following? With that, you also have to identify, well, how are we going to measure essentially the success of that program? Are we providing hedge accounting treatment? Is where you're going to, you know, dictate that as a part of this policy setting? And if so, what are the standards as a part of the hedge accounting that we're going to follow? Remember that with hedge accounting, it's an election, not a requirement. And these are the types of things that are going to be agreed upon here in the front office. There's multiple stakeholders that will be involved across the organization, and it really is essentially the beacon of the overall process. Without this, you really don't have the foundation or the fundamentals that will be followed. With that, once that's done, the policies are established, and it's here then that we execute, right? We're going to execute on those strategies, enter into the derivatives themselves, bring those transactions together with the exposures that we talked about in the prior step. And it's here that it's critical to ensure that the hedges are properly aligned, the policies are being followed. Just as we talked about in the exposure management, it's really critical that there's an investment in the tools that can easily collect that data, that collect that transactional data, depending on the sources of where it's coming from, trading portals or banking platforms or other types of transactional data sources. And then from here, where we'll spend a couple more minutes, is talking about the middle office and the serving and what's done there in terms of kind of monitoring where the measurement of that overall program is taking place. First, with every company, you always will establish your different limits that will need to be tracked. Those are going to be those limits that you're kind of held to. Limits such as exposure limits, right, to your counterparties, helping reduce the counterparty exposure that you might have or might hold. Then the limits will be tracked and reported on a periodic basis. But also you want to be able to also measure them in more real-time fashion and leveraging technologies as discussed as a part of that front office function. If we can integrate that in as trades are collected and we're aggregating those together, if we have technologies in place, they can alert us as whether we're in breach of any of those limits or at risk of breaking any of those limits that have been set. Additionally, here in the middle office is where a company will collect the market data. and calculate the valuations of the overall program that's in place. The sourcing of the data is something I'll elaborate a little bit further upon. However, within the middle office, we really need to take the portfolio of the hedges and their objectives and understand what their current values are in the market, given the different market conditions that really are in place. From our policy set in the front office, remember the various policies that we put in place there, we will know which derivatives qualify for hedge accounting treatments and which ones do not. And it is here that we will perform those measurements and those calculations. The variables that go into that process are going to be a few components. We have the exposures, right? What are we hedging? The derivatives, the hedged instruments that we're using, and then again that market data to know if our hedges are indeed effective or if they're ineffective and they don't align with the exposures properly. It's that test and it's those testing processes that are then going to drive the accounting treatment that's given to those transactions. Diving a little deeper into that, what are going to be the inputs from the market as a part of that overall currency risk management program? I mean, very simply, they're going to be your current market spot rates, your calculated forward rates, and the volatilities which will be needed if you are, in fact, going to leverage options in your portfolio. To value the derivatives in our hedging program, we need to bring these data elements together and have your properly constructed curves. It's there in the middle office where we're still here in that middle office function where we'll take into consideration those current market factors and assess the value of the derivatives in relation to their expected delivery dates. And it's the source of the data and the proper documentation to the results are really kind of going to be the integral part to that seamless FX program. We all know the names that are out there, right? We know that there are many data providers out there in the market that provide this type of information. They're reputable names, of course. When performing this process as a part of that middle office role, we need to clearly provide not only the results of the performance, right? How well did we perform in our hedging, but what went into that evaluation. Clearly being able to document the source set of those rates, the models that you're following, and the quantitative output is going to ensure that your period end is more simplified. That closing process that you're following, it's going to be a simplified and easier kind of process to follow, and that's going to be both for your internal and external regulatory kind of reporting needs that you're doing. Going back and talking about, well, technologies that might be in place, moving from the front office into this middle office, it's important to know the integration options that exist and the tools that you're using. If you have a tool that is collecting the exposures that we talked about and collecting the derivatives that we were talking about, well, how easy is it for that tool to provide and collect market data? Can that tool maintain curves? Can it document the results of the hedges that you have in place? The more systems that are in place to perform the process, the more questions that will arise from audit and introduce added complexities into the overall process that you're following. Regardless of whether you have hedge accounting treatment or not, remember that these types of the valuations that you're doing here will occur and need to be done for the proper accounting treatment that's going to happen. Does the value of that go to your P&L, or will it follow standards in your hedge accounting policies that you have? If designated for hedge accounting, the test is done and depends upon the testing method that has been set, that method that you're establishing as a part of your overall policy. Are you following more simplistic shortcut dollar offset methods of testing, or are you going to use a more preferred long haul regression methods? The answers to that are going to depend a lot upon what we discussed earlier. What is the availability of the market data that you have and the tools you have in place? Something like managing a long haul process in Excel is going to prove to be rather difficult. Can your treasury technology, right, if you're using that or looking at that, can that support the different methods that you're following today or trying to intend to plan in the future? And then lastly, and very briefly before transitioning to Jonathan, there's the back office function. This is a nice segue into more of the accounting specifics that Jonathan will cover. Additionally, outside of accounting, there are other steps taken here related to the overall hedging program. Confirmations of transactions will occur here, and the method followed will depend upon the size of the program, the volumes of the program. Additionally, following that, the settlements have to occur. Integration of the back office functions with the other areas discussed as a part of that front office and middle office will ensure that your true STP, a true straight-through process. Before handing it over, as kind of to close it out, there's really kind of three main things that I guess you should kind of consider, again, as you evaluate your current process and you look into technologies to help as a part of that overall process. Breaking it down, front office. What tools are available to integrate with the other applications that are used? Whether that is, again, the ERP or budgeting tools that you have, will it require development? Is someone going to have to code stuff on our side, or are we going to have a vendor code on their side? Additionally, after the aggregation, can we document that policy that we have and have that kind of centralized as part of that tool? Middle office, going back to the valuation, what's the source of the data that we have? How are the calculations being done for that valuation? Remember that that's going to be the important part of kind of proving the process out for audit purposes, and having those solutions and treasury solutions centralized. It's going to again help achieve that straight-through process. And then back office, once we get the accounting treatment done, how do we ultimately close that loop? How do we get the entries off to the ERP system? And again, same question we asked the front office: is there coding? Is there development? Is there an investment there that needs to be done to help set that up and control that into the future? So with that, what I'll do is I'll transition it into Jonathan, and he's going to talk more on the accounting treatment to be followed based off of kind of the foundation that we set there. So Jonathan.
Thanks, Tom. I appreciate that. Just want to give a brief introduction of myself. I've been with Actualize Consulting for about 2 years now. Primarily, I've been working on treasury management system implementations where we work with the accounting teams, sometimes the technology teams, as well as the treasury teams as well. And that would cover front office, middle office, and back office, all those different functions when we're doing an implementation. Prior to my joining Actualize, I was working for a Fortune 50 company. I was their head FX trader. And prior to that, I was working at a bank for about 4 years, and I was working in the par and distressed credit space. So I just want to say I'm really happy to be here and working with everyone here. So this is great. Next slide, please. So treasury management systems can really help users simplify the accounting of complex transactions through increasing the automation and increasing the transparency associated with these transactions. Traditionally, companies have two general types of risk that they'd like to hedge from an FX perspective. One would be transaction-based risk, one would be translation-based risk. On the translation side, we're really talking about equity in a subsidiary that we want to hedge. On the transaction side, we're talking about either a financial asset or a financial liability. Perhaps it's a euro bond issued from a USD functional entity, or if it's cash flow, then it would maybe be your AP or your AR that you wanted to hedge. Really, the difference between these types of programs that you would see is for a fair value program, you would typically see mark-to-market changes hitting your P&L immediately. Whereas with cash flow and net investment, there's some added finesse to it, where it's actually hitting a separate account. It's not hitting P&L directly. It's going to OCI initially, and then in the cash flow example, your P&L, or excuse me, your mark-to-market would essentially be realized when your cash flow hits, or when that cash is actually moving out the door. For the net investment hedge, it would be typically a situation where you're selling off the equity in the subsidiary. So treasury management systems are able to manage these types of programs very efficiently, because they can match up your exposures with your derivatives, or sometimes if you're not even using a derivative, you could be using like a debt instrument if you wanted to. But essentially what the treasury management systems are able to do is marry these two items together and produce the proper accounting entries that you need in order to be or remain compliant with your hedge program and all the designations that you're making. Part of those designations are disclosures, and we break out those disclosures into two relative types of disclosures, either quantitative or qualitative. On the quantitative side, Tom touched on some of this before, where he was talking about your effectiveness testing. So depending on the type of program that you're engaged in, you could be engaged in producing prospective effectiveness testing or retrospective. And you have the option if you can produce a regression method or critical terms match or dollar offset, etc., depending on what type of treatment you want to seek. So that would be one thing that on the quantitative side in terms of disclosures that companies need to make in terms of how they are gauging that performance of the life of the relationship. In addition to that, how is the system or how is the treasury management system recognizing the P&L? Is it bucketing it correctly? Is it offsetting it at the right time? Depending on the way you've set up your program, and if you're looking at your days in inventory or your days payable outstanding, your DII or your DPO, when that cash moves, that's going to impact when you should be hitting your you should be moving your mark to market from OCI into your P&L. And off the back of that, the treasury management systems also complete their initial measurement of derivatives and exposures and the remeasurement, so you can see a complete picture, life to date, of that relationship as you go through. Now, on the qualitative side, hedge accounting, it does require a fair amount of formal documentation at the time of designation. So things like your risk management objective. What are we trying to accomplish here? What are we doing? The strategy. How are we going to do it? The nature of your risk. What is the risk? In this case, we're talking about foreign currency fluctuations. All those need to be clearly identified in the exposure, the derivative, and the key terms. Those are some of the qualitative things that we need to be talking about in our hedging program. All of that information can be warehoused in these treasury management systems. So that increases the amount of transparency that you have to internal teams within the company, and then also external auditors as well if they need information. So it's things like that where these treasury management systems really help to simplify and add that transparency, add that automation to your day-to-day processes. In addition to that, I also wanted to talk about some of the, or the importance of of reporting flexibility in terms of the types of currency that companies need to produce their reports in, whether you're reporting it in the currencies that things were traded in or the exposures are booked in versus what you're functional in, or maybe what your parent company or what your subsidiary is functional in. That all matters, and depending on what analysis you're trying to do and what you're trying to accomplish, having the flexibility to show different types of analyses in different currencies can be very, very useful. Next slide, please. So, for the next couple of minutes, I also wanted to talk about just, from after the trade is done and after the hedge designation has been made, what are some of the things that we can think about in the future in terms of treasury management systems, and then also some of the regulations that are coming through. So next slide, please. So we're really looking for end-to-end accounting. So when I'm talking about, when I say that, I'm actually talking about something that generates our mark-to-market, moves it from our system into the right bucket in terms of P&L, or if it's going to OCI, and then ultimately back to P&L. If the system is able to produce that and then move it into our general ledger without any hiccups. Now, it could be the case where your general ledger may actually reside within the treasury management system, or the two of them are one and the same. That would be great. But if not, and that's most likely the situation, your general ledger is probably sitting outside of your treasury management system. Now, you would need some sort of interfacing capability, ensuring that whatever entries are coming out of System A would be going into System B. And likewise, you would want a control on either end of that interface to ensure that, okay, what's coming into A is actually what I received from A in B. So it's that type of relationship that you need to think about. You can also think about it from the other direction. Whatever's sitting in System B should be what came out of System A. But really, that's a huge factor. And then also, mistakes happen, right? People make mistakes, and entries need to be corrected. So what happens? Is the system a top-down or a bottom-up approach? Do we have to get at it from the trade level, or can we just make one big entry and fix that? So really, depending on those things, will impact how you will approach your treasury management system and the accounting. The last couple of things I wanted to talk about are really, they're a little bit broader than just accounting, but they do impact accounting teams as well as the treasury teams, and that's really the legislature that's coming through. So we've all heard of Dodd-Frank, EMIR, Volcker, Basel III requirements, and it's important to have flexibility within our treasury management systems to capture all of the requirements that are coming out of the legislature that's been passed. And obviously we don't have a crystal ball. We don't know what other legislature is coming through, but it is fair to say that we may need more flexibility in our systems to be able to handle what other requirements could be coming through, whether that's a different type of report or a different unique ID or something along those lines. It's important just to have that flexibility in your system. And it's important to address these things with your vendor to make sure that they can handle whatever legislature has come through, and potentially if there's more in the future, if they can be flexible and handle that as well. The last point I wanted to bring up is something relevant in terms of it's just happened over the past couple of months now, and that's really a new guideline from ISDA just in regards to how I think it's starting in September of this year, there will be a population of entities or companies that will need to post initial margin on non-cleared derivatives, non-centrally cleared derivatives. So we may be in a situation down the road where FX forwards are going to be fall into this bucket, and we may need to post initial margin on our FX forwards. And I think that should be coming through in September for some population, and then in March of 2017 next year, it's going to be a broader population. So these are the things that we kind of need to be thinking about and sort of planning for, just so that we're putting ourselves in the best possible position to handle the new requirements. And so obviously this is going to impact your day-to-day accounting. It's going to impact your day-to-day cash position, ensuring that you have the right tubes in place to make sure that you've got cash going from one entity to another and then going out the door. So those are the things that I think that companies should be looking out for in the future. And with that, I can pass it back to you, Tracy.
Great, thank you very much, Jonathan. I appreciate that. So I want to thank everyone who's taken the time to join us in our webinar today. We appreciate your participation. And again, for anyone that submitted a question that we were not able to get to, we'll respond to you offline. I'd like to also thank our presenters today, Jonathan Zeman from Actualize Consulting and Thomas Gavigan from Kyriba. We appreciate your time as well, gentlemen, and your expertise. And just as a reminder, everyone will receive a link to today's recorded webinar, as well as the slides and your information on the accreditation. So look for that in the next several days. And if you have any further questions, you can go to actualizeconsulting.com or kyriba.com for more topics. Thanks again, and have a great rest of your day.